Good morning, everyone, and welcome to the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. Today's Tuesday, it's the 14th of June, 2022, and let's bring up our high-risk investment warning. I'll keep this on screen for a few moments, and we'll take a look at the markets. Have been absolutely hammered, haven't they? So we'll just see if there's anything sort of that we can make from the sell-offs. Hey Anna, morning to you. Welcome, and welcome to everyone that's joined this morning. Much appreciated. Let's bring in our market commentaries disclaimer. I actually feel that we've been, my opinion, and clearly it's biased, but I think that our webinars have been pretty much spot on with just the way the markets have been unfolding. So let's see if we can sort of maintain that. The market's always going to be tricky. In terms of our references, market scope, we'll go through the cnbc.com article just to see what the headlines are saying, and then go through to trading view. I'll just put up this chart in a moment. This is trading view. I want to go over this in a moment, but let's just get through the news first, just so we understand what we're dealing with for the day. And the headline reads: European stocks head for mixed open as global markets are rattled by central banks. European stocks are expected to open in mixed territory on Tuesday after sharp declines in global markets on Monday, amid fears that central banks will be forced into aggressive monetary policy tightening, with inflation remaining high. Global stock markets were sent reeling on Monday, with investors reacting to the potential for more aggressive rate hikes by central banks in Europe and the United States after the latest inflation report. The US Consumer Price Index report released for May on Friday came in hotter than expected at 8.6% annually, resurfacing market concerns that actions from the Federal Reserve and other central banks could hike rates more quickly, a move that could risk tipping the global economy into recession. Major averages in the US closed out their biggest weekly decline since January on Friday, and there were further losses on Wall Street on Monday, with the S&P 500 closing in bear market territory. Overnight, shares in Asia Pacific fell again in Tuesday morning trade, although the US stock futures rose on Monday night. Against this backdrop, the US Federal Reserve is central to market action this week, with Fed officials meeting on Tuesday and Wednesday to discuss their next monetary policy move. The Federal Open Market Committee is widely expected to announce at least a 50 basis point hike on Wednesday, having already raised rates twice this year, though market bets for a 75 basis point hike have risen in light of Friday's inflation reading. Yeah, so this paragraph, perhaps it was, I'm not sure when it was written, but the market's pricing in 75 basis points now. It's not pricing in 50. Whether we get the 75 or not remains to be seen. But there is Fed funds futures puts a 90% probability on 75 basis points. So I myself, to be honest, we'll discuss it in a moment. The Bank of England's Monetary Policy Committee will announce its latest interest rates decision on Thursday. The Bank of Japan, Swiss National Bank, and Brazil's BCB also meet this week. Japan's interesting as well. It's backing to keep that 10-year yield at 25 basis points. It's slipping, you know. They have a fight on their hand. And on the data front in Europe on Tuesday, due for release are German inflation figures for May, the UK unemployment rate for April, Euro area industrial production data for April, and Germany's ZEW index of economic sentiment for June. All right. So the Fed is going to make its announcement tomorrow. I don't know if it's going to be 75 basis points. I think it's probably the right move, but it's communicated 50 basis points previously, and which I've always said it was just taking 75 off of the table is just crazy, and now it's come back to to bite them. So I don't know what's going to happen tomorrow, but the market's expecting 75 basis points. Now that leaves us in a huge actual conundrum. Leaves us in a huge. I'll explain that in a moment. I just want to say that I was also listening to a guy on Bloomberg yesterday evening. His name's Professor Jeremy Siegel. He wrote a book called Stocks for the Long Run, and I have it. I haven't read it for a long time, but it was a really good book. So, and he's a very sort of well regarded, I think, commentator. And not only that, he's a professor at Wharton, the business school at University of Pennsylvania. Arguably, the #1 MBA in the world. I think it kind of swings between Wharton and Harvard, but I mean, so he's a heavy hitter. And it's just interesting what Professor Siegel said. He said that the Fed's lost, they've lost the narrative. They need a recapture. They need to be on top of the narrative. He says that they've called for 50 basis points tomorrow. They've called for 50 basis points July. He reckons, well, perhaps to save face, bring the 50 basis points for July forward, lump in 100 tomorrow. Okay, so again, this is what was, and if you Google Jeremy Siegel interview, I'm sure you'll find it. He said, lump it all in tomorrow, make it 100 basis points, make the market see that the Fed's serious about getting this under control. Say to the market that, well, you still kept it at 50, but you've been forced to bring the July forward, so you're sort of front loading tomorrow, and we'll see how the inflation reacts off of that. That actually, to me, makes a whole lot of sense, by the way. It makes so you kind of, you're coming in heavy-handed, but you sort of, it's like a sleight of hand. Like, yeah, I said I'll do 50 this month. I said I'll do 50 next month. You know what? Let's just do it all now. Let's get on top of it before it gets out of hand. And then, we've sort of on a blank slate next month, and we can, reevaluate as the data comes out. And to me, that kind of makes sense. It's kind of keeping to your word, not really, but you sort of can make some sort of like weird argument that you are. And and I wonder if that's something they would consider. So now we've got 3 different scenarios. Will they come in with 50, keep their word, and then say, well, look, we have to put 75 back on the table for July? Will they come out with 75? That's what the market's expecting. Or will they be sort of radical into and perhaps, dare I say, innovative in bringing both of them through tomorrow, make it 100 and see? I don't know, but the problem with this type of market setup is that there are huge unknowns here. That's the problem, huge unknowns. What is an unknown? An unknown is uncertainty. What is uncertainty? Uncertainty is risk. That's the environment. So now, as traders, you've got to make the choice. Do you want to participate in this high-risk environment? Okay, don't discount how damaging risk can be. Now, the flip side of that coin, high risk, high reward, or high reward, high risk, right? There's a link there, but everybody concentrates on the reward and not on the risk side. So if you guess correctly, yeah, you'll do well. But if the Fed comes and does something odd and you're on the wrong side, well, it's going to be very very damaging. So that's the environment we're in. Okay, we're in a very uncertain environment. for the next 36 hours, because it will be tomorrow evening, right? Hey Raj, nice to have you on the webinar. Now, what we have here is the US 2-year, and I've overlaid it with the Fed funds rate. And if I just click on all here, we're looking at trading view. It goes back to 1989. You can see what a good proxy the US 2-year is for the Fed's funds rate. It tracks it pretty closely. There have been instances where there has been significant sort of deviation. So this here would be a significant deviation. So we're going back to sort of the mid-90s. That's about the biggest deviation I can see. So there, the 2-year moves too far, considering where the Fed funds rate actually ended up. But by and large, you can see the sort of peaks kind of match. Here, perhaps there's a slight deviation here as well. Okay, this probably a deviation here. So those are the two big deviations. But then take a look where we are currently. I mean, this is the biggest deviation of them all. So when the market says the Fed's behind the curve, you can see clearly that is the case. And we looked at it before. I actually didn't draw this red vertical in, and I didn't write this red yield gap today. We looked at this a few weeks back. I can't remember when, but you know, the gap's still there. Yeah, so this gap needs to close. Now there's only two ways that this can close. There's only two ways. Either the 2-year has to come down, or the Fed funds has to go up. Right now, the odds are on the Fed funds moving up, not on the 2-year yield coming down. So if that's the case, well, we're looking at 3.3%. So that's sort of a terminal rate of 3.3%. In other words, that's where the turning point is in terms of monetary policy. So if that's the case, maybe the 100-point that Jeremy Siegel proposed on Bloomberg isn't all that crazy, you know. And then maybe you get inflation under control, and then maybe you get the 2-year yield starting to converge towards the Fed's fund rate, as opposed to the Fed's fund rate converging towards the yield, and they kind of meet somewhere in between. So that's just food for thought. Again, I don't know what the Fed's going to do tomorrow. I kind of feel that taking that 75 basis points off the table was just ludicrous. And you know, are they going to go with that 75 basis points? That's the market says they are. Okay, but now, if the market is now pricing in that 75 basis points, well, that was the discounting happening yesterday in the market. So this is where the uncertainty particularly kind of hurts us. Let's say they come in with 50, because that's what they said they're going to do. So let's say the market is wrong, and let's say that the Fed actually says, we told you it was 50 basis points. Why would you doubt us? So let's just say they, well, then there has to be another discounting. So then there's a huge sell-off yesterday to try and get to the 75 basis points sort of levels. They come in with 50 basis points. Well, then there's going to be some sort of rally, which is going to be ludicrous. Like, everybody's going to think, why are we rallying? It's because we over discounted yesterday based on market expectations. But now, what happens if they come in with 100 basis points, which nobody's really talking about? I mean, it's just something that Professor Siegel said last night on Bloomberg. Well, then there's going to be a decline, because there has to be more discounting. So those are the issues that we are facing. It makes it for a tough market, doesn't it? Now, are there any questions around that? Because I want to move on, but I just want to show you there's a huge yield gap here. I don't think moving 100 is all that bad given the yield gap. So you shock the market. but you're on top of the narrative, and you're kind of sort of massaging what you've spoken about previously into sort of a kind of advantageous position, dare I say. I very much doubt that happens, but it's just something that it's, to me, actually makes kind of sense. All right. Thank you, Rob. Thank you. All right, I just want to talk about inflation. I want to just talk about inflation. So let's just bring back core CPI. Now, the reason we're looking at core is because that's the inflation component that central banks control. So we all know that we all feel headline inflation. You and I go into the supermarket and we buy some food, whatever we buy, it's more expensive than it has been in the recent past. But the Fed really can't do much on the supply side. Okay, the supply side is a very tough part of the market to correct, and it's at the moment caught in absolute turmoil, isn't it, because of the invasion of Ukraine by Russia, and that's very much continuing. So I'm not, at some point, and hopefully very soon, this gets resolved, and the supply chains can get back on track, and food gets exported as before, etc. But that's not going to happen. None of us can see that happening at the moment, and so we can't look at headline inflation, but we can look at core inflation, because that's the demand side of the economy. The demand side of the economy is very much in the control of central banks. So let's just take a look at that once more, just to get an idea of how that's going. Now, we know that it missed. We know that it missed on Friday, and it's caused all sorts of panic. It's caused all sorts of panic. Let's just get this. Let's not look at the Fed's funds rate. We know that they're behind. Okay? We know that the Fed's behind, right? So this is core CPI. This is core CPI. Now, forecasting. Everyone knows my view on forecasting. It's very cool. It's very sort of it's very flashy to make a forecast. And if your forecast is hit, then you look brilliant. But you're really just lucky, okay? Nobody can make a forecast with any sort of certainty. There's only 3 ways to make an accurate forecast, and you guys know this. I've said it many times before. There's only 3 ways to make a forecast. So the one way to make a forecast is to hedge it. It's to hedge it, and that's typically what analysts do. They'll say, if we go through this level, then we can go higher. But if we don't go and we through that level, then we actually go below this level, then we're going to go lower. Well, you haven't really told me anything. Either way, you're right. So you've kind of hedged your forecast. So that's the one way. The second way to make an accurate forecast is just to make literally hundreds of forecasts. Eventually, you're going to make an accurate one, and then you focus all your attention on the one that you got right. You kind of sweep all the ones you got wrong under the carpet, and you focus on it. And then the third way is, of course, just to lie. I told you that the markets were going to tank. I told you. It's like, well, when did you tell me? Remember that day? So those are the only real ways. But what we can do is we can try and use statistical tools, fundamental tools, or technical tools, and make inferences based on probabilities. So in other words, there's a probability that you're right, which I guess is closest to the first way. It's like you're hedging, right? So what I want to do here is I want to throw in the RSR. Okay, so we're just throwing the RSR, and we want to put in that 9-period signal line with the RSI. And I think this is a good way to approach the core inflation question. So let's just throw that in. And what we will do here is I want to show everyone the settings. The settings that we use slightly different. Again, there's no magic in our settings. There's just the ones that work for me. So we use a a 10 period. Amongst all time frames, you'll see that they are generally the same, except we do have different settings on our scalping methodology. On the scalping methodology, we actually use a completely different setting for RSI. But for now, we're going to use 10. We're going to use, instead of calculating it on the close, we're calculating it on the median, right? High low divided by 2. And what we want to do here is we want to use a signal line. So typically, signal lines are 9-period exponential moving averages of the actual indicator. So if you take a look at the MACD, this MACD signal line is a 9-period exponential moving average of the MACD, right? So we want to put in a signal line, and then we'll just change this to 9. And we're going to put this as an EMA. And I think now we've got something that's workable. Okay, so I think now we've got something that's workable. And you can see that the crosses here. So when the RSI, so this is the RSI of core inflation. So which is effectively the internal sort of the strength, the internal yes, just call it that, the internal strength of it's when it starts losing that power. So when it kind of rolls over and crosses below the signal line, well, we've probably topped out. Okay, let's take a look here. Similar, we've probably topped out. Now, why have I gone through to 75 and 80? Because these were the periods, the previous stagflationary periods, and this, of course, is where the oil shocks were previously. And again, I would suggest all the way up, people were calling for sort of peaks, all the way up, people calling for peaks. But it was really when we got this crossover that we saw the actual peak. And what's interesting now is you can see the RSI has rolled over here. So there's this flat out panic. Okay, there's this flat out panic because we missed on Friday, which is not a surprise if you look at it in terms of the RSI. Our RSI hadn't crossed over, right? But well, why weren't they panicking before Friday? Now the RSI is actually rolling over. We're probably pretty close to the peak here. Probably. Okay, I don't know, because there's no way to know, because forecasts are, you know, just that, forecasts. They know that they're not real. So the idea is, yeah, we're probably close to peak. In other words, all this panicking, okay, it's kind of it's late. You know, the forecasts were early. So we can see that the RSI now is starting to roll over. So again, I'm just going to repeat what I said last week. I think we're pretty close to our apex. In other words, I think we're pretty close to peaking. I could be wrong. I just think based on the fact that we're kind of rolling over here, and if we cross below, well, that's how the previous stagflationary periods ended. It's not to say that that's how this stagflationary period ends. Maybe it crosses over to the downside and then crosses back up to the upside, and we'll have to deal with that when it comes. But you can see that I think we're pretty close here to the apex. So all this kind of worrying about inflation, well, if we are pretty close to that apex here, let's go back to that that 2-year yield. Let's go back to that 2-year yield. Okay, and let's just get rid of this RSI. Don't want it here. And let's put back the Fed funds rate. Okay. Okay, let's just put the back line. And well, if you take a look at that CPR, and we're pretty close to peaking, in my opinion. I can't say for sure, but we're rolling over in terms of the internal strength, RSI. Well, then I think that just kind of reinforces what Professor Seeger was saying. Get the 100 points, get that 100 basis points. So what 100 basis points is, it's a full percentage point. You know, raise it by that full percentage point, pull that that CPI down so that the RSI crosses over. So force it to cross down. Let the adjustment take place now on the yield side rather than on the Fed's fund rate, because you've pushed that 100, and see if that is sort of the fix. Now, I don't know, you know, I'm just throwing it out there. I was giving that some thought, obviously, last night, and I thought that's quite a novel way to think about it. Is it going to happen that way? I highly doubt it. No, but it's just something that I wanted to kind of throw out there. Let's just say we get that 75 basis points. It might do exactly the same thing, right? It might force that RSI to cross over. So that's kind of what we need to keep our eye on. I think the time for panicking, you know, was last week, not this week. But we are panicking. So now we've got to address the whole story of this panic, and that in itself is going to be something that is very difficult to actually deal with. So I was thinking, what's the way that we can approach that? So I think I want to do it on two levels. I heard yesterday that the yield curve is flattening again, from Anna. Well, it inverted. So, or it briefly inverted, I think. So we can take a look at that. It depends which sort of yield curve, which part of the yield curve you're looking at. So you're looking at sort of the 2s, 10s, which we're going to look at now, 5, 30s. So if we just take a look at this, let's see what we get. So we're pretty close to inverting, right? So yeah, so what's Anna saying is like is that the yield curve has flattened. Well, the answer to that is yes. She's 100% correct. Okay. How do we know that this is flattening? Well, look at what we're doing here is we've got the 10 minus the 2. Let me bring up Microsoft Paint, I was going to do that anyways. And what you can see is that we're basically at 0%. Like we had a 1 basis point basically between the 10 and the 2, right? So so basically, think about it this way. Okay, I'll just show you, because it's quite looking at that graph, at that chart, can be a bit confusing. You've got a 10-year bond. Let's just say that it's yielding 3%. Yeah, let's just say that. You've got a 2-year, okay, that is yielding 1%. Let's just say that. Okay, so if you kind of plot in 1% is much lower than 3%, 2 years is much shorter than 10. So you're going to get a steep curve like that. Okay? But assume now that you are not at 1%. Assume now that you're at 3%. Okay, when you're at 3%, okay, well then you're at 0. 3 minus 3 is 0. From the 2 to the 10-year is just going to be on the 0 line. Understand? It's flat. Yield curve, that's what Anna's saying. It's flat, which is right, because we had 0, flat. But where it gets interesting is when it inverts, because these inversions typically precede recessions. So the reason that it's flattening and the reason that it's heading towards inversion is because there is heightened fear of recession. Quite right. Yeah. So 100% would agree. What I would suggest here, and what I would suggest here, is that a dip below zero I don't think it's all that meaningful. We're flat. We're not inverted. Okay, if it kind of dips and then is back above zero, that's not an inverted yield curve. That's a flat yield curve. And you know, but if we spend significant amount of time below zero, well, that's inverted, and that is, I think, a cause for concern. So just a kind of little blip over here. You know, I kind of like, is it or isn't it? But here, yeah, that's below. Yeah, that's below. So I think we just got to spend some time on this chart and see if it spends a significant amount of time below zero. Then we've got a problem on our hand. We've got an issue. All right, let's just bring this up. I hope that answers the question. Just let me know if I addressed it. I want to show you why inflation is. Why are we getting hit? Why is the stock market getting hit? Okay, so the stock market's getting hit because of inflation, and it's getting hit because of higher interest rates. They're working on two different levels, but they're working at the same time. And that's the hard thing about economics or finance, is that there's multiple layers, and that's why forecasting is so difficult. But let's just talk about input costs for the time being. So the way that an income statement works, we're not going to go big into it, so just bear with me. Your top line is what we call sales, okay? The second line is what we call the cost of sales, okay? And then you've got your gross profit, okay? We're not going past gross profit, okay? So basically, let's just say you are making $100 sales. Let's say to make those $100, it's costing you $50. So to make 100, it's costing you 50, but that's leaving you with a gross profit of 50. Okay, so I think everybody gets that. Okay, the cost of sales is the cost of making your 100. So what you can do is, I'm going to take this out, this underline. So what you can do is you can take your gross profit. So you'll take your gross profit, which is 50, and then you can divide it by your sales, which is 100, and that's going to give you what's 50 divided by 100. Okay, well, we know it's 50%, right? It's giving you a 50% what we call gross margin. So margins are important in terms of your business. You want to have a high margin business. If you've got a low margin business, there may be reasons for a low margin business, but it could be that you want a very competitive environment. But the point is, throughout the income statement, you get various levels of margins: gross margin, operating margin, net margin. So you can clearly see here we're getting 50%. Now, watch this. Let's assume inflation, but let's say that the inflation is hitting the business on the cost side. So you've got a question now, and your question is, do I absorb those costs? Do I, as a business, absorb those costs, or do I pass them on to my customers? Now, we all, as customers, are sensitive to prices in one way or the other. When prices go up, we generally purchase less of that product, okay? And it depends on the type of product. So, for example, insulin. Insulin, you can't really cut back on. If you are a diabetic and the pharmaceutical companies ramp up the price of insulin, well, there's not much you can do because you need it to survive. By the way, that is exactly what they've done. The cost of insulin is exorbitant. When it was invented, sort of in the late 20s, the doctor, the pharmacist that invented it, sold it, I think, to a pharmaceutical for $1 and didn't want his name associated with it because he thought it was unethical to profit from that. Well, guess what, right? They're profiting from it. So that's just an aside. But the point is, so some sales are sensitive to price increases, some aren't. That's called elasticity. Let's just do some math here. Let's just say that the units sold here are 100 units. Okay, let's say units sold equals 100. Okay, and if units sold is 100, well, then your sales price must equal $1, because you're selling 100. Your sales is $100. So $1 times 100 units is giving you $100 in sales, right? So what's your per unit cost of sale? What's your per unit cost of sale? Well, that would be 50 cents. Must be 50 cents, right? 50 cents per unit, because 50 cents times 100 is going to give you $50. I think we can all see that, right? Now, what happens if cost of sales increases by 10%? So now our cost of sales has increased, and it's not 55 cents. Sorry, it's not 50 cents, it's become 55 cents. Okay, so now you've got a choice to make as a business. Am I going to pass that on to my clients, my customers, or am I going to absorb it? You're probably going to pass some of it on, you're probably going to absorb some of it. I'm not sure. Clearly, let's just say that the product that you're selling is into it. Let's say that let's just say that the price has increased by the costs have increased by 10%. You can pass that on. Let's just say you can pass that cost increase of 10% onto your unit sold, onto your selling price. So your selling price then becomes 105, because now you just adding that extra cost onto your selling price, because you want to cover it. Okay, you want to cover it. I think everybody gets that. And this is kind of a very theoretical example. It's the best case example, because nobody's going to be able to pass on their cost 100% without doing some serious damage to the quantity sold. We're going to assume unit sold stays at 100. Okay, so now let's do our math. Okay, so 1.05 times 100 units means your sales has increased to $105. Okay, your cost of sales is going to increase to $55. Okay, so the question is then, okay, well, what is my gross profit? Well, it would be 105 minus 55, which gives us 50. Guess what's happened? Your gross profit is exactly the same. You've passed on your increasing costs to your clients beautifully. Okay, you've maintained your gross profit. See that? But some things happened on the gross margin level. This is why the markets are repricing, because of inflation. So let's just take a look at that. We want to work out our gross margin. Well, your gross profit now, okay, is 50. That's exactly the same. But your denominator, your base, is not 100. It's 105. Okay. So now you go 50 divided by 105, and your margins, your gross margins have dropped to 47.62%. So your margins are getting hit by inflation, even though in this sort of completely theoretical example, you've been able to 100% pass your increasing costs on and not lose any sales. Guess what? You still be hit on the margin level, and that will just filter down through your income statement. So, and eventually that will move onto your balance sheet, and your balance sheet will be slightly weaker because of that, right? So the whole idea here is inflation hurts. Even if you, no worries, Anna, understood. So the point is, even in a perfect scenario, inflation is hurting. So that's the one reason that the markets are repricing. Okay. The second reason, so just going back to our conversation about core CPR peaking. Well, I think that would help stabilize to some extent. We've still got the PPR, the production side. That's a major concern. I don't know how we're going to deal with that. But perhaps if the demand side stabilizes, then this awful repricing that we're seeing in the market might stabilize. So that's the one thing. And then, of course, the other thing is the time value of money, which we saw yesterday's. And we'll just do the, we're not going to do an example here, we're just going to put the formula, and that is just your present value equals your future value divided by 1 plus interest, okay, to the power n. N is time, let's call it t. And interest is not really interest, it's actually, this would be your required rate of return, so there'll be some premiums onto that. But that aside, what the point here is that we know interest is going to increase. Tomorrow it's now either going to be 50, 75 or 100. So your denominator is going to go up. So of course your present value is going to go down. That's the pricing that we see. That's the pricing that we seen yesterday. So you can see that this is sort of two variables which are working at the same time. The margins are getting hit by inflation, and your discounting is getting hit by the higher interest rates. One last thing, and then we'll end. One last thing, and then we're going to end. The market's having a real sell-off at the moment. The question is, where do we go with it? Are we near the bottom? Are we? And of course, the answer to that is we don't know how far. We don't know where the bottom is. But what we can do is we can look at this in terms of Dow theory. So we know Dow theory, the bear market has 3 stages. Okay. And the stages, we've gone through them before. The first one is called the abandonment of hope. We're long past that. Okay, we're long past that. The second one is called declining earnings. I think we, are seeing that especially to take a look at your big retailers, right? But now this is where the question is: are we here? Is this where we rampant? It is panic selling. This is the last stage, and this is where we probably are, the panic selling stage. So this is kind of the last panic selling is kind of the last of the bear market stages. We don't know where we don't know if this is taking place, because I think it's going to very much depend on what the Fed does tomorrow. Perhaps again, imagine they bring in it as 100. That leads to a huge sell-off because of the repricing. But that's kind of the end of the stage, panic selling. Well, if we kind of get there, that leads into stage 1 of the bull. Okay, and stage 1 of the bull it's a stealth stage. You don't see it unless you know what you're looking for. So that would be renewed confidence. And of course, I think our webinars are, again, I'm probably biased, but our webinars I think are better than most. So we know what to look for. We'll be looking for that renewed confidence stage. And that's really what I have to offer this morning. So we haven't really looked at many charts. So it was kind of theoretical, but I think very much relevant to the markets. The markets at the moment, you've got to make that decision. Do you want to participate? It's high risk, a very high risk. Okay, and high risk. Even if you put in that stop, what happens if it gaps below your stop? Okay, so just give that some serious thought. Any thoughts? Any thoughts or questions? Please go ahead and type those in. Any thoughts or questions? Please go and type those in. Hey Sam, nice to have you on the webinar. No, so London has we dropped London, we've dropped US. This is not called the DAX webinar anymore. It's called the morning market review. So we try and review everything in this one webinar. We still do the crypto minute, and the reason is there's a much bigger focus on written content at the moment. Yeah, this is our main webinar now. I don't. I'd like to schedule a scalp webinar, Sam. So I think when the market settles, we'll do a scalping webinar. But again, because the US webinar has been cancelled, it's difficult. So that's a great question, and I really want to do it, but we have to try and get the timing right. Yeah, absolutely. Rob's just saying, can we cover QT at another stage, at another time? And I think we have to try and cover it. The second part of your sentence, I think, is huge, Rob. So Rob says, I don't think I really understand what it will do with interest rates, and I think that's the actual key, Rob. I don't think any of us do. So we'll try and make sort of sensible inferences and come up with something cohesive and sensical, but I don't think any of us understand what it's really going to do. But yet, we definitely must do that. So let's get through the Fed. Let's get through the Fed, and then we'll revisit that. Thursday is a public holiday here, guys. I just wanted to let everyone know, but I'll tell you again tomorrow. All right, let's wrap up there. Have a good day ahead. A good evening. We'll and then tomorrow we're going to do the crypto minute, which is very, very. I think it's a very interesting market to analyze. I just don't want to do it now. There are some compliance concerns around that. I'll explain that all in the crypto minute tomorrow. Thanks, guys, and chat with you tomorrow. Cheers. Same time, Sam. Yeah, same time. Sam, if you need the link, to that, just email me. You've got my email address, right? I'll just okay, cool. All right, excellent. Okay, cool, guys. Chat to you tomorrow. Cheers.